Happy New Year, everyone. This is Mark Kinney, Chief Investment Officer of Newport Private Wealth, with our fourth quarter investment update. I probably don't have to tell you, the close of 2018 saw a sudden and dramatic return of market volatility. There are many plausible explanations, from trade wars and tariffs, to recessionary fears on rising interest rates, lower corporate earnings growth, Brexit, even program trading. No matter the reason, it was the darkest December in history as stock markets erased the year's gains and then some. As this chart shows, all equity markets finished the year down. Only bonds and cash provided very modest returns. But what does all this mean for you, and how did Newport perform in this environment? Let me start by recapping that our primary focus in every market environment is to protect your capital. And over a full market cycle, typically 3 to 5 years, we expect to meet or beat our benchmarks after fees with less risk and volatility. For 2018, our balance fund was down less than 1%, while the benchmark was down 3.5%. 4 of our 5 portfolio mandates met or beat their benchmarks. The 5th, our income mandate, was off by only a few basis points. Over the past 3 and 5 years, our balance fund has delivered returns of 5 and 5.6% respectively. Benchmark returns for the same time period were just 2.76 and 3.57%. All of our mandates met or exceeded their benchmarks over these periods with less volatility. I realize this is of little comfort to those of you who joined us in 2018. We would have liked to have delivered positive returns right out of the gate. We're working hard to remedy that. Looking behind the numbers, what did we get right in 2018 and where did we give up performance? On the positive, we entered the fourth quarter with a lot of cash, between 15 and 20% in most portfolios. In a normal environment, we would hold less than 10%. Our caution was effective in protecting capital and allowed us to take advantage of the buying opportunity created during the sell-off. We put over $60 million of that cash to work late in the fourth quarter, setting portfolios up for success in the next leg of the cycle. For the most part, our public equity managers also performed in line with or exceeded their benchmarks in what was a difficult year. Value Invest, our value manager for global equities, even managed a positive return in the fourth quarter. There were 2 negative surprises in our portfolio. 1, the performance of our value manager for North American equities was a detractor. This was due to its overweight position in Canadian equities and the energy sector in particular. We are reviewing the performance and the strategy with the manager. As well, we own preferred shares, which sold off with the broader market. We expect a rebound in 2019 as interest rates have stabilized. While we wait for this to play out, we collect a high level of income. Our private alternative investments were positive contributors and a major offset to weak public markets. They did precisely what they were designed to do: contribute to steadier returns and lower volatility in the portfolio. Our real estate portfolio is now large and diverse, consisting of retirement homes, garden-style apartments, commercial properties, and large urban apartment buildings. It took several years to build out the portfolio, but as these assets have matured, the results of leasing and capital improvements have materialized. Capital is being returned to us through higher rental income, refinancings, higher appraisal values, and asset sales. This helped our strategic yield fund deliver an 8.47% return in 2018, and our balance fund, which holds it, to outperform as well. We are taking a similar approach with our private debt portfolio, a unique asset class with low correlation to public markets. In the fourth quarter, we invested some of our cash to add new investments to this portfolio. We expect annual returns of 8 to 10% once the money is fully invested. In closing, I'd like to offer a few words about market volatility. We know that it's unpleasant, and we work to minimize it for you through alternative investments and other strategies. We expect 2019 will be another challenging year for investors as global economic growth slows. We're not forecasting a recession, but equity returns could again be under pressure. Our continued caution and exposure to private investments will be key supports. Some volatility, however, is unavoidable. Where investors can get into trouble is in reacting to volatility. The danger is illustrated in this chart from EdgePoint, one of our global equity managers. It shows the average investor consistently performs worse than the overall market because they change course at precisely the wrong times. It is our job to make sure this doesn't happen. Investment success over the long term will be a combination of the actions we take as your manager, coupled with the actions you take as an investor in staying the course. We are truly grateful for your trust and your patience while we invest your money for long-term success. Wishing you all the best for 2019.